Hey everyone, my name is Oliver Turner. I'm the Executive Vice President of Corporate Development for Karora Resources. Karora Resources is a Western Australian-focused growing gold producer, taking gold production from about 100,000 ounces 2 years ago up to 200,000 ounces by the end of next year.
Good to see you, Oliver. Hope you're well, and thanks for joining us. You put the news out. Obviously, you hit over 40,000 ounces for the quarter. Great news. You better tell us the numbers because I want to kind of get into what it means and what it holds for the future. So maybe give us a rundown of last quarter.
Yeah, absolutely. So on a production basis, it's just over 40,800 ounces, which is a new record, which we've been notching consistently. Obviously, we're growing gold company right now, so one hopes their records quarter after quarter. So that was a great production quarter. On the sales side of things, over 42,000 ounces sold. We had a few ounces to make up for at the end of last quarter, so we managed to clear those through the books, which is great. So continuing on that trajectory towards our guidance this year, which is 145 to 160,000 ounces. We produced just over 80,600 ounces year to date, so obviously positioning us quite well, especially considering the fact that we're expecting the second half of the year to be strong. So looking good on ounces there. We'll be reporting our financial results in mid-August as per usual, and everything's in line with guidance as well. So looking good.
Well, it is looking good, but I guess here's the question for you, right? You keep executing and delivering what you say you're going to do. You're not necessarily getting all of the credit for that, right? So I get the market's kind of quiet across the board, but you're a gold producer continuing to produce, good margins. Which must be good for your balance sheet and your exploration budget, et cetera, et cetera. What's it going to take? What should people be looking at?
Yeah, I mean, if there's one thing about this in terms of share price performance in terms of this company, it moves quickly on the way up and it moves quickly on the way down. There's certainly lots of beta leverage in this name, and I would actually argue certainly alpha on the name too. But what it will take is continuing to notch those quarters. We're not through the growth plan yet, right? So we're looking good for our guidance this year. We still have to deliver into that ramp up next year. The good news is most of the development work in terms of the vent raises and the development decline obviously is finished by the end of this year. And next year will be about bringing some additional stopes online and adding equipment and ramping up to that 2 million ton per annum rate at Beta Hunt. So executing on that this year and next year is important. There's also the massive potential that we have in terms of the nickel. The market that we're in today is deliver it, report it, and I'll believe it when I see it kind of environment. So once we start to notch some of those expanding nickel quarters as well, we only have modest production for this year of about 500 nickel tons. That will start to deliver as you start to see those margins expanded, which in this high cost environment is certainly important as well. And then if we get back into a market where you're starting to be rewarded, obviously via the drill bit and announcing those results, the results that we announced there at Fletcher should certainly be moving share prices. They aren't for anybody these days, but would love to get back into that kind of market as well. So executing, adding cash to the balance sheet. We added, as we reported just yesterday morning, about $5 million net of all of our capital spend, net of the stamp duty for the Lakewood acquisition last quarter. So it's a very unique situation where you have a growing gold producer that's deploying capital into a growth plan, that's deploying significant capital into an exploration and resource upgrade program at the same time as adding cash to the balance sheet, not dropping cash into the program. So it kind of checks all boxes. And we've seen some strong movement lately, obviously, in the share price, which has been quite nice. But yeah, it's a good place to accumulate right here.
Right, but why? Okay, I hear what you say. Okay, you're net $5 million up from last quarter. You've doubled the stamp duty, $4.5 million. The exploration budget has been allocated to a meaningful exploration program. But isn't there a game to be had for the market where perhaps you don't spend so much? You are seen to be accumulating a large cash pile which you can deploy in something more exciting like M&A. Why is this conservative, considered approach better than perhaps, I don't know, playing the usual market game that others do?
Yeah, well, I mean, first and foremost, decisions aren't made on a quarter by quarter basis, right? So there's the market swings, short-term market movements. but mines are long-lived assets that you need to be very careful about, not only your technical deployment and technical plans, but also your capital allocation. These are decisions we make based on multi-year projections. They're not things that we make for the next quarter, the next 6 months, where the market is trading right now, where interest rates are right now. We think about the long-term viability of these operations. To take a quick step back, remember at the beginning of all of this, Beta Hunt had 400,000 ounces in resource, well over 2 million ounces now. So it is a slow and steady growth execution strategy that we are delivering on, that is enhancing long-term fundamental value, that ensures that this asset is going to be a free cash flow generator for a very long period of time. Now, to answer the second part of your question in terms of why not spend a little bit less, well, of course, that comes at the cost of growth. So, in this environment, we put out a plan to grow Beta Hunt, to grow the company to just under 200,000 ounces by the end of 2024. We laid out that plan a couple of years ago, and we're executing on it as we laid out. What do we do after that? There's a couple other things we can do with Beta Hunt. We talked about the nickel, just bringing that online. Is there some great optimization we can do? Beta Hunt is a massive system. And one thing, if you actually want to take this lens to M&A, that every single intermediate and senior producer, we're not quite in the eyes of senior producers yet, but certainly in the eyes of intermediate producers, is looking for are single assets with over 10 years of mine life, 200,000 plus ounces a year, significant exploration upside, low risk jurisdiction, ability to permit. That's exactly what we're building at Beta Hunt. Those are exactly the kind of assets that people want. So those are important when you're starting to think about long-term attractiveness to other let's say acquirers. And let's not kid ourselves here. We're starting to see consolidation at the top end of the spectrum when it comes to the senior producers. That's going to step down into the intermediate producers. So it's all about building a longer-term vision that provides all aspects of the game for investors.
Right, and I guess the other aspect of that is so in terms of capital allocation. It's not just about making yourself attractive, it's making yourself defensible, or at least in the position to negotiate a better price. A lot of distressed assets out there, distressed companies out there with good assets, but nevertheless cash stressed because margins are shrinking. Inflation still wages a war out there. Whilst gold price is good, margins have not necessarily followed through on that one. So let's talk about capital allocation for you then. If we're going to be conservative and considered and accretive in planning, where are you allocating your money in terms of the exploration budget? You've got a lot of moving parts when it comes to exploration. You've had some great results across the multiple assets, but what's going to be important to you in this environment in terms of that kind of defensible and value creation position?
Yeah, and that's a great question as well. And you hit a couple of things bang on. Let's just talk about margin first, and then we'll get into that capital allocation thing, because I think one plays into the other. We've seen a wonderful ramp up in gold price, and it's been wonderful, especially in this increasing interest rate environment, to see gold, broadly speaking, remain above $1,900. That is not the expectation when you're having other assets yield higher. So that's been fantastic for gold price. We love this gold price environment. 3-4 years ago, we would have been saying, yeah, give us 1,900. But our cost environment was very different then in terms of input costs. The single largest one across the entire mining sector and across most sectors right now is labor. Labor is very, very sticky. Labor costs have increased dramatically. Consumables too, we're starting to see some relief in things like diesel. But the point being, while the gold price has gone up, the costs have gone up at a higher clip. So your margin has actually shrunk. Now, Karora is in a very enviable position, and this isn't by luck, this is by design. Where we have, as you said, multiple levers that we can pull. So if we were in an environment right now where margins were, let's say, $9,000 an ounce, $1,200 an ounce, and we're printing cash left, right, and center, we would be funneling a lot more money into Higginsville exploration than we are today. Now, why are we putting more of our $20 million budget that we have while preserving and increasing cash while deploying into a capital program? We put $20 million into the ground. Why are we putting almost all of that, and why have we been putting almost all of that into Beta Hunt? The simple truth is ROI. For every dollar that we put into Beta Hunt from our existing infrastructure at Beta Hunt, we are able to turn that drill meter into an ounce, into a resource ounce, and potentially into a production ounce, in under 2 years. If we were to discover something massive, at Higginsville. And let's just take a moment here to talk about Higginsville, because Higginsville has been extremely important over the last several years for us to ramp up our production, right? I talked about at the beginning of this call, us being just over 80,000 ounces halfway through the year. That's more than we produced 3-4 years ago, right? So the company has grown massively. Higginsville has played a key part of that growth. Now, where we are in Higginsville today is we're mining these smaller open pits and undergrounds. However, if we were to discover something big at Higginsville, and given the 1,800 square kilometers we have there on that Saluka Shear, I said this on your platform before, it is probably the most prospective exploration ground in all of Western Australia, and I don't say that lightly. If we were to discover something big there, it would take several years, tens of millions of dollars of drilling to bring on, let's say, a new, very large open pit, multi-million ounce deposit, right? That couldn't be mined and turned into cash, free cash flow and cash immediately. So in this higher cost environment where you have fewer dollars coming out the back end, you have to allocate them into what can make me more cash in the shortest amount of time possible. That's where Beta Hunt is swallowing up these dollars. And that's before we even talk about the nickel side of things, which will be starting to ramp up next year when the ventilation works as well. So that's how we've pivoted internally. We've decided to put more dollars into Beta Hunt. It's an asset that we're growing. It generates cash. Higginsville, once we're done this capital program at Beta Hunt, more of that cash will go back into Higginsville for some of that longer term large exploration.
Right. So to be clear, when you say short term, well, potential short term, you're saying it's the quickest means to generating cash. You're not saying to the exclusion, to the detriment of the future. We're just saying right now, because where the infrastructure is located, it makes more sense. You're going to be more economic, more margin by focusing on Beta Hunt, right?
Yep. Yeah, that's
okay.
For sure.
Okay. Super. Right. And the next thing I want to talk about is basically it's something like it's the market. The market conditions are tough out there. I've interviewed a $3 billion gold company. They are struggling. Their margins are let's quote, they're a little bit stuck, a little bit difficulty because they haven't actually brought new assets into production quickly enough. They're 2-3 years out from being able to do so. Whilst exhausting their current assets, it's problematic, right? So that planning is really, really important, and the phasing of all of the assets is really, really important. That's why I was belaboring the point somewhat. Perhaps, if you do you mind sort of laying out the timing across the board as you currently see it? I know you've given guidance, but perhaps you're sort of changing as data comes through. Are you changing your mind on any of that? Are you seeing new opportunities? Are you looking at perhaps reallocating capital because of that?
Yeah, and it's a good question and a good point made, and kind of comes back to what we talked about in terms of not chasing this short-termism, but actually, you've got to plan and you got to think in multiple year horizons when you work in the mining sector, because it takes a long time to do the correct due diligence, analyze projects, permit, and get ready to bring new projects online. And that all has to stack into your mining plan in order to make sure that you're continuing to generate cash, and cash generated from one asset goes into the other to enhance your returns. Now, when it comes to what you just described, I mean, again, if we just keep coming back to Beta Hunt, since we've started drilling at Beta Hunt, the entire resource used to be hosted on Western Flanks and A Zone alone. Since we've come into the asset and into the company, we've added 7 new shear zones, right? 7 new shear zones. Probably the most recognizable of late to investors would have been Larkin. That was added last year. We added several 100,000 ounces there, which is phenomenal. So we keep adding these shear zones at Beta Hunt. And why do I keep talking about this? Again, the infrastructure is in place to mine these things as quickly as we can bring them online. So our planning in terms of mine planning is continuing to add these shear zones, add significant ounces to Beta Hunt, and tucking those into the mine plan. And then what happens is you get a little bit of shifting. So as we discover areas of higher grade, we're bringing those earlier into the mine plan if it makes sense from a present value perspective. So some of the optimization is happening there. And then, of course, I keep coming back to the nickel. That's going to start playing a more important part. When it comes to Higginsville, we've gone through probably about 6 or 7 different deposits since we first started ramping that up post the acquisition. We had 32 brownfields targets when we came to the asset. We have several more deposits to work through as well. but we don't have that next big one at Higginsville. But that's going to have to wait until we can allocate more dollars into that drilling post this capital program. So really, it is Beta Hunt is just stealing the show. It's basically turning into a free cash flow machine and something that we can really anchor as our foundational asset for the long-term future.
Right. So, there's the planning on the gold development front, sort of production front, and you're heading quarter after quarter. So all kind of good stuff in the gold. You've mentioned obviously nickel, lithium. You got a few other byproducts going on there. Which, I mean, again, how do you in a market like this work out the timing of how you monetize those things? Because obviously lithium's going on a tear. Nickel market is strong. You're finding more nickel than perhaps you realize you have. It's kind of interesting times, but at the same time, you don't want to get distracted, but maybe there's an opportunity at the right time. So how are you viewing those?
So another good question. So I'd say one is more physically limited, and the second one is more of a market timing that we've executed on. So when it comes to the nickel side of things, as with everything underground at Beta Hunt in terms of increased activity, it's those 3 ventilation raises that have to go in, right? We finished the first one the first quarter, second one's well underway, third one will be done by the end of the year. With that increased ventilation capacity, up goes gold production next year, as well as increased nickel activity. So trust me, we are chomping at the bit, literally and figuratively, to bring up that nickel production as fast as we can, but it's limited by that ventilation. So once that's in next year, we'll be allocating more drill dollars towards that. We'll be starting to get more mining activity in those areas as well. So that's the nickel side of things. On the lithium side of things, as we saw the hard rock lithium environment in Western Australia specifically, but Australia in general, basically just fly through the roof. We realized that there's very high likelihood that we had lithium on our property. As I talked about in previous discussions with you, we ran a study. We figured out what we had. We're rolling into this Cali Metals vehicle, and we realized that, look, as a management team focused on gold and now nickel, and nickel due to the fact that it's next to gold in our mind, we realized that we wouldn't be able to basically allocate management time and resources to that lithium as well. So we do not, to your point, want to be distracted. So we decided to create that separate vehicle for that to be accelerated for shareholders as a direct flow back to our shareholders via the 45% ownership there, and ensure that that thing has moved forward in what is certainly a very hot market today. So that one's more of a market timing thing that we're bringing forward, and the nickel side of things is more physically limited by when we get more activity going there.
Right. Okay. So the whole package, please. The whole package. Macro market, we're going to describe great gold price environment, great for producers. I'm interested to see what they're doing. You've explained, carefully what you're doing here, but how do you think you're doing relative to your peers? I mean, in terms of that relative performance indicators out there, do you think that you've done okay? Are you looking at others and saying, well, actually, perhaps you've got something to learn, something to deliver?
Yeah, so I mean, again, it's all based on time horizons that you look at. We certainly had moments where we dramatically outpaced the peers to what's the best way of putting this? Almost violently successful effect. And then we've had other points when obviously the share price has moved down quite frequently. That is, by the way, a product of incredible trading liquidity in a name for a company of this size due to the legacy of what's happened previously at RNC. So. It certainly is a good trading stock and checks all liquidity requirements for larger indexes, which is a good thing, such as the GDX, which potentially we could be relisted on at some point in time. But if we look at today, right? So I've got the screen up here as I do every day in terms of what's happening in the market. Over the course of the last month to 3 months, so if you look at 1 month or you look at a quarter, we're mildly outperforming the GDXJ, which is our closest benchmark, right? We can all pick names that we're dramatically outperforming, and we can pick 1 or 2 names up at the top that we're underperforming. But if we use that broad basket that fund managers compare us to, and that's what they benchmark their performance to, we're outperforming, somewhere to the tune of 3 to 10% of the course of that period of time. If we look at year to date versus GDXJ, we're at GDXJ. Yeah, we're underperforming by about 7 or 8% right now. Now, of course, that can flip in a day or two, but I'm just giving you numbers as I was reading them off the screen this morning. Now, if you look at the 12-month, performance, we're outperforming by about 39 or 40%. And if you start to think about investing, not betting, investing, not trading, right? You start to think about longer term performance. Where do I want to have core parts of my portfolio If I want exposure to gold miners, you start to thinking, and you think in that multi-year horizons, well, and when am I going to make 2, 3, 4, 5 times my money with a large portion of my portfolio? These are the kind of names that you want to put your money into. There's always going to be the hot stocks that go up on a stick in 3 weeks, and guess what? Inevitably, they go back down again, more than not, right? So to create a true investment vehicle, which is what we've been doing over the last 4 years, which is directly reflected in the shareholder register that you see today. You have some of the top names in the entire sector that have very large positions in us. Those are the kind of moves that we like to make, and that's the kind of vehicle that we want to be.